All right, everybody, welcome back to the Mateus Mula Show. We're going to be talking about the bros today. Let's get a little streamception while we get the background up, hot, and ready for you guys. Let's see. If I move this over here, you guys, nope, okay, we're good. So I'm moving this over to the right so I can read. First and foremost, for those of you guys that check this out on Thursday, November 7th, 2 days after the election, we had a great conversation, me and Mr. Patel, hour and 53 minutes long. If anybody's ever curious about HELOCs, SB locks, how to leverage appropriately and not fucking go belly up, just in general about cash flow chronicles, things that you think about when you start getting a decently sized portfolio for the average American. We're not talking Bezos, we're not talking about Elon over here, but some of these strategies they actually utilize. We talk a little bit about what Zuckerberg did for buying real estate, stuff of the like. But shout out to you guys. We had 216 people at the peak, over 174 on average. If you guys don't follow us on Cashflow Chronicles, be sure to check us out in the description and follow us. It's a lot of fun. We love doing it for you guys. Next, I want to just talk about specifically Dutch Bros, the conference call. This is a little bit of a quick overview. First and foremost, I think Christine Barone did a really good job introducing really what, to me, I think Dutch Bros is going to continue to excel at, and I think it's part of the reason why they continue to have strong revenue growth and EBITDA growth. But first and foremost, they have a relentless focus on the culture. They had over 400,000 applicants for 11,000 jobs. They're really, really trying to focus on growing inner talent, people being able to come on as a broista and develop within. And I see that, right? And one of the key things, they opened up one 2 or 3 months ago here, a couple blocks away from me here in Houston. I used to have to drive 10, 15 minutes to go to my closest one. Now it's literally a 3-minute drive away if there's no traffic. It's probably more like 4 or 5 minutes away, but you know what I mean. They literally flew people in from California, Arizona, New Mexico, places where you have different broistas and different sort of backgrounds. All these people have been a part of established stores before, so all they wanted to make sure is that culture is really the thing. They don't want to just say, hey, here you go. And the thing that's very different about Bros comparatively to, say, other stores that are out there, it's mostly company owned. So, and we'll touch a little bit about that when we get into the investor presentation. So it's mostly company owned, so they can really harvest that culture and really cultivate it to be what they exactly want it to be. So actually moving into the financial performance, 30% year over year growth. We'll touch on that a little bit more. EBITDA is growing just as strong. I couldn't remember. I think it was 28%, but we'll see when we get into the presentation. But the thing that I think is the most important, which I didn't see in the presentation, but I heard through the conference call, is that complementing the EBITDA growth, the company actually added $30 million in cash to the balance sheet. And why is that important? You'll see in a little bit, but basically, in simplest terms, in fiscal year 2024, they were supposed to make $200 to $225 million in EBITDA while spending about $225 to $250 million in capital expenditures. So we're getting to that place where, yes, the company's profitable. Yes, they're, on a cost of goods sold comparatively to what they're selling things at. They're making a margin on that they're able to do things, but they're taking a lot of that margin and reinvesting back into the business to be able to grow the amount of stores that they have. Now, of course, if you're outspending and spending more capex than you're bringing in terms of gross profit, then you're eventually going to go bankrupt, right? So the hope is that you have enough cash on hand, you have enough liquidity that you can grow your store count and eventually get to a place where not only you have enough EBITDA, but you actually are able to have enough EBITDA to cover your entire capital expenditures and then some, to the point where then you can start buying back stock, paying dividends, paying down debt, or increase the amount of stores that you open, knowing that they have a really good rate of return on every store that they do open. We'll get into that in the presentation as well. That being said, the fact that they did have $30 million in cash means a lot of it, I think they stated, was due to working capital. And in the Q&A section, they basically said, hey, is this an anomaly? Should we expect this here on out? Are you even willing to give it to us in this point in the call? They did say that there's going to be Investor Day early in 2025 and that they would be more willing to talk about that then when ops cash will cover capex. So basically, say a break even point, right? Not break even on profitability, but break even on, you know, capex versus cash flow, right? So at the point where you're actually having free cash flow back to the business that you can then use for other things like debt pay down, etc. It makes it seem like right now it's an anomaly quarter, whether it was a working capital build, etc. But we'll find out a little bit more. My thought process is late 2025, early 2026, we should be at that pivot point where it's on a very consistent basis going forward. You might have an anomalous quarter here or there with working capital builds, whether you're spending a lot of money in Q1 for builds that are happening in 3Q, and then there's not a lot of money coming out in 2Q, and so you have a positive 2Q in terms of cash build. That could happen, but I'm thinking on a trailing 12-month basis, you probably won't start seeing it till late 2025, early 2026, to be a more consistent path going forward. Same store sales growth of 2%, 4%. I think it was like 2.5%. We'll see in the presentation. 4% for company operated stores, meaning that the franchises are still lagging behind. Average unit volume persisting above $2 million, which is huge. And it just goes to show you how well things are going in the fact that they're continuing to expand, have wide open playing field as they go east from West Coast to East Coast, and that the infill locations that they're doing in Texas, Dallas, San Antonio, and throughout, everywhere that they're opening up, in reality, you're still maintaining at $2 million, which is pretty impressive, because sometimes when you put things too close to each other, they steal from each other. Yes, you might incrementally get, let's just say 1.5 or whatever, but the fact that you're able to get a store right next to each other and still average system-wide $2 million a store, it's absolutely phenomenal. CapEx to build these stores is about 1.7. So of course they're coming out of pocket 1.7, and then I think they get the money back once they convince somebody to buy it off of them. So store growth is about 150 for fiscal year 24, 160 for fiscal year 25. We'll touch a little bit more on that in the investor presentation. Mobile order rollout. This wasn't something I saw in the investor deck, but 90% of stores have now that. Christine talked a little bit about it during the Q&A and also in the introduction to the presentation. It's not necessarily like adding, let's just say, landmark amount of new customers, but it is accessing new customers. You're seeing a 5% or so throughput increase. And the people that are signing up for mobile orders, generally speaking, are also signing up for the app itself, which generally speaking is meaning they're new customers that haven't been there before. So it is accessing them some new customers overall. So it's a small increment, though. It's not a step change, right? But I think even if you think about it in this perspective, 5% more throughput, is really pure profit, because if you're basically already covering your operating expenditures for a lot of those things, then overall, it's really just pure profit for every additional cup of coffee or drink that you sell. They are talking about expanding food menus. So if anybody's familiar with Dutch Bros, they sell 3 different types of muffin tops and a granola bar. Granola bar is absolutely phenomenal. The muffin tops are honestly phenomenal as well, but it's not a huge thing, and they're also very carb heavy. So it's like, can kind of make you a little bit sleepy, but they are really tasty, and they can last a while in the fridge for a day or two if you decide to pick one up and you think you might need something a day or two down the road and you just want to have it in your fridge or something like that. So interesting to hear that they are testing different food menus in several different, I think they said 5 or 6 different locations in the Southwest, and they'll expand that into 2025 and try to perfect that throughout 2025 for a 2026 rollout company wide. And they wanted to make sure that, one, it not necessarily is like a very expansive menu, but what they're hoping is that it's something that allows people to think about getting something quick, right? Like a quick meal. And the hope isn't necessarily to make a crap ton of money on the food itself, but really inspire people to show up for another drink, what it seemed like. So like a muffin or like a pastry or something of the like that will allow them to be like, oh, well, while I'm here, let me get another cup of coffee. So I think that's where they have the majority of the margins. So if they can kind of sell that as almost like a way to get somebody to show up twice a day instead of once a day, I think that that's really what they're hoping for. So hopefully they'll be able to get some more folks around lunchtime, dinner, mid-morning, something like that to help them tide them over. And during that time, they'll be able to get another cup of coffee. So hopefully an incremental amount customers that weren't there normally. Another thing that I saw, so we'll see a little bit more, and we'll go through the calculations. So market cap is at about 7.5 billion. It might have pulled back a little bit because I might have grabbed that when it was up at $50 a share today, because the stock has rallied massively, up about 40 or so percent at its peak in one day, which is absolutely crazy. It was like $34, and it shot up to $50 at one point today. So congrats to everybody that's been following me on the journey. But I think if you're at 200 or so $1 million in EBITDA for the year, you multiply that out by 33x, you get $7.5 billion market cap. So considering the EBITDA is growing 20 to 30% a year, high 20s, low 30% per annum, the profit margins are continuing to do really well. They have a lot of tailwind associated with where they're at right now. They're going to be a self-funded business within the next 24 months. I think that they have a lot of capital still on the books to be able to fund in the short term while they're getting to kind of cash flow break even. I think there's a lot of positives here, and I think that it's something to not necessarily get rid of in terms of people thinking that the stock might have run too high at this point. We'll talk a little bit about it in a second. New openings, new locations in the blue. Haven't necessarily seen it go into new states, maybe. Still waiting for them to enter Georgia. Still waiting for them to enter North Carolina and South Carolina. They've been in Kentucky for a while. They've been in Tennessee for a while. It is nice to see them open a few stores here in Tennessee. Or sorry, Florida. They did have 2 or 3 the last time I checked. Now they're up to about 4 or 5. So cool to be able to see that. Hopping over to the headlines here. 338 million in revenue, a 28% year over year. Complete the mobile app capacity rollout, and raises revenue and adjusted EBITDA guidance. So let's just take a quick look. So they increased store count overall, pretty decent, 20%. 135% company operated, so they are still increasing franchises, but I just don't think that they're getting more franchisees. 28% year over year growth, so they went from 265 to 338 million. That's huge, especially when you're looking at the company operated margins at 31%, 29.5%. Not surprising as they're continuing to grow. It's going to cost money to grow. You're not going to have the most efficient shops, but hopefully once they get a rhythm in there in the right ecosystem, hopefully they can kind of maintain that 30% range. And then if you think about it, $74 million added, immediately adding 30% of that to the revenue, you can kind of start to come out with, how it's looking in terms of the growth of EBITDA. It's not like for like, because obviously you're going to have costs of goods sold and everything like that, and run rates and SG&A and things of the like. But 20% year over year EBITDA growth. I thought it was closer to like mid to high 20s, but what was me, I guess. But you can see that you still have an adjusted EBITDA margin of about 18 to 20%. I think that it stays there. That should be good. I hope to see it kind of continue. I know that 3Q is generally one of their rougher quarters, if I remember correctly, or it might be one of their better quarters. Actually, let's just go back and check. Do they have that in here? They normally have like a slide that shows where their better quarters are. But anyway, same store sales growth. So system wide was 2.8%. So I messed that up. Oh, sorry, 2.7%. So I messed that up, guys. And then company operated was 4%. So I said this was 2%. It's 2.7. So good for us. Transactions for all system was 1% up. The ticket sales were 2% up. And then more specifically for company operated, total transactions was up 2.5%. Ticket sales themselves was up 1.6%. This is the trajectory. So 4 quarters after opening, the first quarter, obviously you're losing money, but you're starting to generate positive gross profit. So basically your ticket sales minus whatever the cost of goods sold is, but you're still getting things ramped up. You're probably not getting as much throughput, etc. But on a 2020 to 2024 average, you're looking at within the first 4 quarters of opening a store, 24% gross profit margin, which is pretty good. It's in line with what you see most coffee stores overall. Like Starbucks, I think, is like 25 to 30% gross profit. So to be able to see that within 4 quarters, and hopefully you'll be able to get it closer to 30% over time, and that's what we generally see over time, we're averaging about 28-30%, based off of this initial slide, 29.5% here. So hopping over to the actual revenues and things of the like here. So company operated stores 308 million. Then of course you had the company profit 90 million, with when you take into account depreciation and everything of the like. So that's where you get that 29.5%. So pretty good. If you're thinking about where you're going to end up, you're at about 1.2 to 1.3 billion a year. Hopefully growing that at 20% or more per annum. So in a couple of years time, hopefully you get to 2 billion. You're going to be making about, $600 million or so in gross profit. Throw a 10 to 20 multiple on that, more like a 20 multiple. And you're talking about a $12 billion, $13 billion company, doubling where you're at, right? And it's not going to take too long to get there, right? So there's that piece. Rule of 72, right? If you're growing at 20% per annum within 3 years, you're pretty much, 3.5 years, you're going to be doubling up. So there's that. This is how contribution margin has changed. So price impacts, they increase prices, labor has gone up. This is minimum wage and stuff on the West Coast. Maintenance, discounts, etc. You get to 29.5%. Total system stores for 2024, 150. They've raised guidance for revenue 1.255 to 1.26. Hoping for same stores growth of 4.25%, 1 to 2% for Q4. EBITDA, they're hoping for 215 to 220. So this is an increase. SG&A, of course, this is sales, general, administrative costs, 195 to 200 million, and then capex. So hopefully they hope to be able to get this adjusted EBITDA and capex as close to as possible, and eventually get to a place where they're outpaced, right? Adjusted EBITDA outpaces capex, so you can start adding to the bottom line. That's pretty much it. You get to the actual workbooks and everything of the like. I think the thing I want to show is a steady increase here in net income. So you're going from, let's just say negative 16 million in Q1 of 2022 to steady profitability now, and continuing to do extremely well. Single digit $1 million adjusted EBITDA to now getting into the $60 million adjusted EBITDA. Q2, I think, is always the strongest quarter. So if you're going to build, do 23 over 48 over 65. So they're kind of increasing at 15 to $20 million increments. Hopefully we're able to consistently do that going into 2025 as well. That's ownership, net income. Let's see. Is there anything? One thing I like to see, the adjusted EBITDA margin continue to go up as well. Last year was a little bit better, but you're starting to see it kind of top out at this 20%. I hope eventually it gets closer to 25-30% overall, but it's okay. I think you can sacrifice a little bit for now while you're still trying to grow the company. Was there anything else in here, man? But like I said, you don't, when you look at the presentation like this, it's why you sometimes have to really listen to those conference calls, because nowhere in here did it talk about I'll just move my screen over here. Nowhere in that presentation did it talk about expanding the food menu to roll out for 2026 to try to get an additional coffee sale per day per individual. Nowhere in there did it talk about the working capital build. It didn't highlight it. I'm sure if you went into the numbers, you've been able to see the working capital build that eventually got you the adding cash to the balance sheet and being positive in terms of cash flow for the quarter. So small things like that. You don't see the culture piece. You do see the branding, which helps a little bit, but that piece about just being diligent, making sure you listen to the actual presentations that some of these executives give. I mean, a prime example is why this stock excites me. You listen to the call and you just, maybe it's because I'm invested and, from I think it's really cool passion standpoint, but also I'm physically invested in the company via my financial dollars. But Amit was listening to some of these conference calls today in the closing. Like he was listening to Grinder, he listened to Archer, and he was just like, these are boring as hell. Christine makes it, in my opinion, she's the CEO. She does a good job. She's got a good background in marketing. So she's able to kind of come up and show her passion for what's going on at Dutch Bros. And so to me, it ended up being a pretty good conference call. And I think that they answered a lot of questions about the future of the company, where they think they're headed, what the runway looks like. Are they continuing to maximize their real estate strategy? How they continue to invest back into the company? And that's another piece. Like, they talked a lot about investing in the company, investing in the talent, and investing. It's like, so all those things are percentage points here, percentage points there. So I'm okay with it because real estate to me is the biggest and most important thing. That's what's going to move the revenue. And so to me, it's okay sacrificing a percent here or there to be able to make sure that they are able to grow, let's just say 10, 15, 20% more stores, because 10, 15, 20% more stores, let's just say it's another 10, 20 stores a year at $2 million a pop. The following year, that's going to be generating $20 to $40 million more in net revenue growth, and the EBITDA associated with that's going to be 20% of that. So you're talking about an additional $4 or $5 million. So taking $1 million here, $1 million there to get $4 or $5 million that following year in terms of EBITDA, in my opinion, is good return on capital. So it might be difficult to show up, and it might not necessarily be $1 million here, $1 million there. It might be a couple 100,000 here, a couple 100,000 there. But what I am saying is reinvesting back into the company at this point is warranted, knowing how much gross profit margin you're able to make off of each individual store. So the amount of stores, in my opinion, is really what's going to be driving this. So you start thinking about long term, right? So right now they have a goal of about 4,000 stores. And to make the math simple, and we could take away and put some margin on this, they want about 4,000 stores. Let's just say they do get the $2 million annual unit volume, right, of off the 4,000 stores. And I know some of those stores will be franchised initially, but my anticipation is at some point they'll have 400 or 4,000 stores within the next 10 to 15 years. So let's just assume they get to that 25% margin, EBITDA margin, and that gets you to a basically $2 billion a year EBITDA. And the company right now is worth $7.5 billion. So $7.5 billion divided by 2. That's currently a price to future EBITDA. Of course, this is long term, and this is in my anticipation pre-international expansion, which is another leg up to it as well, right? But you're paying 3 to 4x basically price now to future where it's going to be in 10 years time. Now, of course, it's not there yet. But what you do know is eventually next year you're going to be at $250 million in EBITDA. So take that $7.5 billion market cap right now. You're going to be at 250 next year. You're paying price to EBITDA today at 30x, and you're growing at 20 to 30% per annum. That's not too bad, right? So let's just say you grow it at 20% per annum, 250, and then you grow it at another 20% next year. Maybe you'd be looking at 260 to 275. So let's just say you get 275 next year. You're at a $7.5 billion at 275. You're looking at mid 20s, high 20s price to EBITDA growth for fiscal year 2025. So you're looking at a great company. I don't think you're paying out the wazoo, even at these prices that you're seeing today. Let me just double check if it's still at $7.5 billion. That's a number I picked up earlier, so I'm curious if it's come back down to reality. $6.9 billion, so even a little bit better. So it's come back down now to a little bit of reality since it's dropped below back $45 a share. Hopefully, that squeeze, people were able to sell at $50 and maybe buy back in, get a couple percentage points here and there. But overall, man, I think the company's doing great. 24 minutes long in the video. Let's just kind of cut it there. But if you have any questions, put it in the comment section. We'd love to hear what your guys' thoughts are. Congrats to everybody that's been following me on this one for over a year at this point. I think I started covering it in like July, August of last year, and it's been a blast. And I've really fallen in love with the company. And is it the top five company in the top five company in my portfolio? No. But as you can see, steady earner, right? It had a cost basis of $28 going in to yesterday, and yesterday the stock was, even before it popped overnight, it was $35. So what is that? 35 minus 28 divided by 28. I was up 25% yesterday, and now I'm up what, 44.6 minus 28 divided by 28. Now I'm up about 60% on the position. I do have covered calls, unfortunately, at $39. So hopefully I'll be able to roll those over the coming months and get out of it. But I think it's just people recognizing this company is pretty good. And if you don't have a position, consider it. Maybe wait for a pullback, but I still think that 10 years down the road, this is a good opportunity. So hope you guys enjoyed. Talk to you soon. See you on the next one. Cheers.